how does a property market, see transactions plummet by up to 31%, while in the exact same week, someone signs a lease to rent a single house for 17 million dirhams a year?
Yeah, that is the big question right now.
I mean, just think about that. That is one person paying roughly 7 million Australian dollars just to rent a house for 12 months.
Right.
And this is in a market where transaction volumes are supposedly in free fall. So, welcome to this deep dive. Today, we are grabbing a mid-July 2026 market intelligence report from Dubai Property for Aussies.
Which is a fantastic report, by the way.
It really is. And the mission for us, and for you listening, is to look past those, flashy, gold-plated headlines of Dubai real estate. We want to extract the actual actionable mechanics at play for an Australian investor.
Exactly, because we need to figure out if this current market correction is, a giant red flag or actually a highly engineered golden entry point.
Right. And the paradox of those two statistics sitting side by side in the same report. It's just wild.
Well, what's fascinating here is that paradox is exactly what makes this specific moment in time so compelling. We are looking at a market that is aggressively fragmenting.
Fragmenting how, exactly?
So the forces driving the everyday apartment market, they've completely decoupled from the forces driving the ultra-luxury tier. They aren't even acting like the same market anymore.
Wow. Okay.
Yeah. So to understand if this is an entry point for you, we have to pull apart the actual plumbing of how these transactions are happening on the ground.
Okay, let's unpack this. The most logical place to start is, I guess, the highest altitude view, right?
Yep.
The raw macro numbers
Yeah.
from the first half of 2026.
Right, the H1 data.
Yeah. The report states that H1 2026 saw 286 billion dirhams in total sales.
Which is just a staggering volume of capital flowing through the city. I mean, to contextualize that, 286 billion makes it the second best first half on record for Dubai.
Ever.
It is only trailing behind the unprecedented, frenzy-driven boom we saw back in H1 of 2025.
Okay, and that comparison to 2025 is really where this entire correction narrative is stemming from, right? Because the data shows transaction volumes are down anywhere from 12 to 31% year on year.
Depending on the specific segment you look at, yes.
And prices have eased, 4 to 7% from their quarterly peaks. Plus, rents, which are obviously the lifeblood of any property investor, dropped 8 to 10%.
Right, which sounds scary on paper.
It does. But in this bizarre twist, average prices are actually still up about 6% compared to the first half of 2025. I was trying to wrap my head around this feeling of panic in a market that is fundamentally still growing.
Yeah, it's a weird psychological space for investors.
It is. And the best analogy I could come up with is being in a sports car. You've been flying down the highway at 150 kilometers an hour. Suddenly, the driver eases off the accelerator and you drop to 110.
Oh, I like that.
Right. The physical sensation is that you are slowing down. You get thrown forward in your seat. It literally feels like a deceleration. But if you look out the window, you are still moving incredibly fast.
That's a perfect way to look at it. The sensation of slowing down doesn't mean the engine has stalled, It just means the vehicle has returned to a sustainable speed limit.
Because you can't go 150 forever.
Exactly. A market moving at 150 kilometers an hour forever eventually runs out of road and crashes. So the easing of prices by 4 to 7% from the peak, that's just the market finding its footing.
I hear that, but I have to push back on that a bit, especially from the perspective of an investor relying on cash flow.
Sure, go ahead.
If average rents across major communities are dropping 10%, isn't that a giant flashing warning sign?
Yeah.
I mean, if I'm modeling my mortgage repayments on a specific rental yield and suddenly my tenant has the leverage to demand a 10% discount, isn't that a sign the bubble is bursting?
I get why it looks that way, but we have to separate a correction from a crisis.
Okay.
How so? Well, we do that by looking at the underlying mechanism causing the rent to drop. A crisis is when demand just evaporates. Say a major local industry collapses and thousands of expatriates leave the country, right?
Leaving apartments completely empty.
Right. That is a true demand shock. But what the data in this report outlines is a supply absorption event. This is market normalization, plain and simple.
So, meaning the peak was the anomaly, not the current state we're in now.
Exactly. During that 2025 peak, rents were artificially inflated by a severe temporary lack of supply and just intense speculation.
So what changed in mid-2026?
Fast forward to now, and a massive wave of new housing supply, like towers that started construction 3 or 4 years ago, they are finally being completed and handed over.
Ah, I see. So suddenly, a tenant who previously only had one option for a two-bedroom apartment in the neighborhood now has five options.
Right. And when renters have choices, landlords are forced to compete on price, which softens the rents by that 8 to 10%.
They literally have to discount just to get a body in the door.
Yeah. And while that hurts the landlord's immediate yield slightly, structurally, it creates a much healthier environment. It shakes out the short-term speculative flippers who are highly leveraged and, relying on peak inflated rents just to survive.
Leaving who behind?
What is left is a stable landscape for well-capitalized long-term investors.
Well, if the speculative froth is being blown off the top, that completely changes the psychology of the people who are still choosing to buy.
Oh, absolutely.
And the report highlights a pretty profound shift in buyer behavior here. Because for the first time since 2021, ready property, meaning completed physically existing buildings, overtook off-plan property in total sales value.
This is a huge milestone.
It's massive. Ready properties hit 146.7 billion dirhams, edging out off-plan at 139.8 billion. But wait, isn't Dubai's entire global reputation built on selling glossy digital renderings of skyscrapers before a single shovel hits the dirt?
Historically, yes, very much so.
So why the sudden obsession with actual bricks and mortar?
Because in a normalizing market, risk tolerance just plummets, and buyers prioritize certainty.
Right.
During a massive boom, people aggressively buy off-plan because they're basically buying a derivative. They want to ride the wave of capital appreciation while the building is still just a hole in the ground.
Hoping to flip the contract before they ever have to pay the final installment, I bet.
Exactly. But as price growth stabilizes, like we just discussed, that strategy becomes incredibly risky.
Because the music stops. And you don't want to be the one holding a contract for a concrete shell you actually can't afford to settle on.
You nailed it. So the calculus shifts entirely toward immediate, tangible returns. Buyers want the physical piece today so they can put a tenant in tomorrow and start generating cash flow immediately.
That makes total sense.
Furthermore, ready properties are just much easier to finance with a standard mortgage from a local bank. It allows investors to use leverage rather than fronting a massive cash payment to a developer for something that doesn't exist yet.
The developers must be feeling this whiplash intensely, though. I mean, the report notes they slam the brakes on new project launches.
Oh, they definitely hit the brakes hard.
We went from over 45,000 units launched in the first quarter of the year to a meager 5,335 in the second quarter. That is a massive drop.
It is.
Plus, developers are suddenly stretching their delivery timelines out to 4 years and offering incredibly flexible post-handover payment plans. It seems like the power dynamic has completely flipped from the seller back to the buyer.
It is a classic hallmark of a maturing market. Developers are now competing for a smaller, highly selective pool of end users and yield-focused investors.
They can't just rely on hype anymore.
No, they can no longer just throw up a billboard and expect a tower to sell out in an hour to speculators. They have to actually engineer payment structures that make financial sense for the buyer.
Well, let's drill into that financial sense, because the report provides some very specific yield figures for these ready properties. The gross yields are averaging around 6.9% right now.
Which is strong.
Very strong. If you are an Australian investor looking at a 3% or maybe 4% yield in Sydney or Melbourne, a 6.9% gross yield sounds like an absolute goldmine.
It does, but there is a massive caveat in the data here.
Right, the report explicitly cautions the reader about this. You must strictly model for net yields, not gross. The hidden carrying costs in Dubai can drastically alter your return on investment.
Yeah, you have to be so careful with gross figures.
It totally reminds me of buying an apartment in a high-rise on the Gold Coast. You know, the real estate agent sells you on the amazing weekly holiday rental income, but they conveniently gloss over the massive strata fees you have to pay to maintain the elevators, the resort pool, and the gym.
The Gold Coast analogy is actually highly accurate for Dubai.
The report points out that in Dubai, these service charges can eat up 10 to 25% of your gross rental income. That's huge.
It is huge. When you factor in those service charges, which, by the way, are calculated per square foot of your property, plus property management fees for an overseas investor, and the inevitable void periods between tenants.
Right, when it sits empty.
Exactly. That shiny 6.9% gross yield can quickly compress into a 5% or even 4.5% net yield.
Which is a big difference.
It is. I mean, it is still a solid tax-free return, but you have to run the math meticulously. The critical step is verifying the building's historical service charge schedule through the government's regulatory portal before you sign a contract.
Okay, so the broader market is acting rationally. Everyday buyers are seeking the certainty of completed properties, they are recalculating for net yields, and developers are reining in supply. It's all very
Yeah,
sensible.
very rational, yes.
But how does that logic square with the ultra-luxury outlier we teased at the start of the show?
Yeah.
That world record, 17 million dirham annual lease in Emirates Hills. Who on earth is paying that, and why when the rest of the market is cooling?
Well, to contextualize Emirates Hills for an Australian listener, think of it as the Point Piper of Sydney or the Toorak of Melbourne, but overlaid with extreme global wealth.
Okay, so the absolute top tier.
Exactly. This segment operates entirely independently of the mid-market economic forces. While mid-market apartment towers are seeing a flood of new supply completing, there is a severe documented scarcity of ultra-luxury mansions.
Because you just can't build them fast enough.
More like you simply cannot manufacture a new Emirates Hills overnight. The land and the exclusivity are finite.
Ah, so it's pure scarcity mechanics.
Precisely. When global high net worth individuals relocate their families and their capital to Dubai, they are all fighting over a static, tiny pool of trophy assets.
They aren't looking for a 6% yield, are they?
Not at all. They are looking for a lifestyle fortress, and they have the capital to drive prices to record-breaking extremes regardless of broader market trends.
Wow. And that perfectly resolves our opening paradox. A 31% drop in mid-market speculative transactions can absolutely coexist with a record-breaking luxury lease because they are, functionally, two completely different economies operating within the same city limits.
That's exactly right.
Okay, so buying a finished building solves the immediate risk of a developer going bankrupt. But how do you guarantee that specific building will hold its value or even appreciate over the next decade?
That is where you have to look at the macro city planning.
Yeah, the report points a giant neon arrow at the infrastructure happening outside the front door. We are talking about massive structural government spending.
The scale is honestly hard to comprehend sometimes.
Let's look at the billions being poured into the ground right now. First up, the Metro Blue Line. It's a 20.5 billion dirham project, 30 kilometers long, opening in September 2029. And the crucial detail here, Phase 1 tunneling just completed on July 9th.
Which is a huge signal for investors. It means this is no longer a speculative proposal on a city planner's desk. The capital has been deployed, and the physical rewiring of the city is actively underway.
Right, and it connects areas like International City, which, according to the report, is currently yielding 9 to 10% gross.
Yeah, those are very high-yield areas.
And the Roads and Transport Authority, the RTA, projects a 25% value uplift for properties near these new stations by 2040.
Which is a very specific, actionable metric for you to use.
Exactly. Then you have the Gold Line, 34 billion dirhams, approved just this week. 42 kilometers connecting major hubs like Business Bay, which yields 6.5 to 7.6%, to JVC, yielding 7 to 9%.
It's massively expanding the transit grid.
And it's not just trains either. Al Maktoum Airport is a $35 billion project designed for 260 million passengers, with Phase 1 opening in 2032. They just contracted Mitsubishi for the People Mover system. Plus, there's a 2 billion dirham road corridor awarded this week that cuts travel time on a major route from 33 minutes down to 15 minutes by the end of 2028.
The scale of this civic engineering is phenomenal, but if we connect this to the bigger picture, the key for the investor is understanding the mechanism of transit-oriented development, specifically in a climate like Dubai.
Right, because of the heat.
Exactly. Why does a metro station add exactly a 25% uplift to a property's value? Because tenant psychology in a city that hits 45 degrees Celsius in summer places a hyper premium on proximity.
I can imagine. Walking in that heat is brutal.
It is. A 5-minute walk to an air-conditioned metro station versus a 15-minute walk is a massive distinction in quality of life. Tenants will consistently pay a premium for that access, which drives the rental yield, which ultimately drives the capital value of the asset.
Okay, here's where it gets really interesting for the investor trying to time this capital appreciation. It's essentially the real estate version of buying the rumor and renting the news.
Oh, absolutely.
If I'm looking at that blue line, it opens in 2029, but they just finished digging the first tunnels today. How do you time this? Do you buy now while the neighborhood is a messy construction site, or do you wait until you can physically see the train running to eliminate the risk?
Well, the infrastructure value curve is pretty well documented globally.
Yep.
If you wait until 2029 when the ribbon is cut and the trains are running smoothly, that 25% projected value uplift has already been completely priced into the asset by the seller.
So you basically missed the boat.
You missed the boat entirely. The strategic opportunity lies in the specific window of time between the project being irrevocably committed, like the tunneling finishing this week, and the project actually opening to the public.
Oh, I see.
You acquire the asset while the surrounding area is still dealing with construction dust and traffic detours, knowing the government has essentially handed you a map telegraphing exactly where future demand will be concentrated.
Okay, so we've established the strategy here. Buy ready properties near these newly funded infrastructure nodes. But for the Australian listener sitting in Sydney or Perth, how on earth do they actually execute this?
Logistics are always the big hurdle.
And more importantly, based on the report, why is this specific moment in 2026 a unique window of opportunity for them? Let's break down the Aussie advantage. First, the golden visa rule change.
This is a huge shift.
It really is. In early 2026, Dubai drastically altered the rules for their 10-year residency visa. The threshold is an investment of 2 million dirhams, which is roughly 780,000 Australian dollars. But the monumental change is that they removed the old requirement, where you had to put down a 50% cash deposit. Now, standard mortgages are fully eligible to qualify the asset for the visa.
Yeah, the removal of that 50% cash hurdle is a structural shift in accessibility.
How so?
Well, it transitions the visa from a luxury product only available to high net worth individuals with $1 million of liquid cash sitting around to a strategic financial play available to, upper middle class professionals.
And the financing to execute that play is surprisingly cheap. The report cites one-year fixed mortgage rates for UAE residents starting from 3.75%.
That rate is incredible compared to what we're seeing elsewhere.
Oh, absolutely. Anyone listening in Australia right now who is rolling off an old fixed rate into a 6% or 7% variable rate is probably weeping hearing that number.
Oh, without a doubt.
Add to that, the Australian dollar is sitting near multi-week highs against the US dollar, tracking between 0.698 and 0.700. The Reserve Bank of Australia is holding rates at 4.35%. So the Aussie buying power is comparatively muscular right now to make that initial 20% deposit.
It's a very strong position to be in.
Plus, Emirates and Qatar Airways just got cleared for daily flights out of the new Western Sydney International Airport, meaning the physical connectivity between the two markets is literally being cemented.
The macroeconomic alignment of currency strength and comparatively low UAE borrowing costs creates a highly favorable environment to deploy capital right now.
I agree, but I have to pump the brakes here for a second because the report includes a massive flashing red warning light that we can't ignore.
The travel advisory.
Yes, the Australian government's Smart Traveller website explicitly lists the UAE as Level 3 reconsider travel. And that isn't just a warning about exploring the desert. That includes simply transiting through the Dubai airport.
This raises an important question, yes.
The report points out that standard Australian travel insurance might be entirely voided if you go. So how can any rational investor safely execute a property deal if they can't even fly in to inspect the property or sign the papers without voiding their insurance and ignoring federal travel advice?
It is a critical logistical hurdle, I won't deny that, but the mechanism to bypass it is entirely legal and highly established. The reality of the Dubai property market in 2026 is that the physical presence of the buyer is completely obsolete.
Really?
Completely. The digital infrastructure allows for entirely remote settlements.
Okay, how does that actually work in practice? Walk me through the mechanics of buying a house without seeing it.
So it relies on a trustless, cryptographically secure framework managed by the Dubai Land Department. First, you agree on the price digitally. Then, to bypass the travel warning, you authorize a power of attorney. You can do this remotely via video call with a certified digital notary or locally at the UAE Embassy in Australia. That authorized representative in Dubai acts on your behalf. But the crucial protection for your capital is the regulated escrow system.
Okay, so you aren't just wiring $780,000 to some random seller's personal bank account.
Never. The funds are transferred directly into a secure, government-regulated escrow account. The seller does not see a single cent until the Dubai Land Department officially transfers the digital title deed into your name.
Wow. So you entirely circumvent the physical risk of traveling to a level 3 zone while still accessing the financial opportunity.
Exactly.
And when you frame that remote settlement capability alongside the visa change we just talked about, the true scale of the opportunity really comes into focus.
It fundamentally reshapes portfolio expansion for an Australian investor. You can sit in your living room in Melbourne, put down a standard 20% deposit using a strong Australian dollar, secure local UAE financing at 3.75%, acquire an asset near a future metro line, yielding a net return that easily services that debt, and, on top of all that, simultaneously secure a decade of residency rights for your entire family in a tax-free jurisdiction.
That is just, wow. So what does this all mean for you listening? If we synthesize this entire journey we've been on today through the Dubai Property for Aussies report,
Yes, let's tie it all together.
you aren't just looking at a property market that is correcting. You are looking at a market that has matured past its speculative peak. Developers are finally being forced to offer realistic, flexible terms.
Right.
The government is pouring tens of billions of dirhams into physical transit infrastructure that provides a literal map for future capital appreciation.
Yeah.
And the ultimate prize, the 10-year golden visa, is finally accessible via strategic leverage instead of requiring a massive lump sum cash injection.
It is a rare alignment of variables for the disciplined investor, the one who looks past gross yields and actively models the true net return. But, there is one final piece of context in the source material that I think requires serious reflection for an Australian investor looking at their long-term wealth strategy.
Oh, what's the final piece of the puzzle?
The report briefly mentions a new capital gains tax bill introduced into the Australian Parliament on July 2nd.
Right, the CGT changes.
Yeah, this legislation proposes significant changes to CGT rules, specifically targeting foreign residents who hold Australian property.
Okay, so essentially, if you decide to leave Australia for work or lifestyle, but you keep your family home as an investment, the tax rules are potentially shifting to penalize you.
That is the implication, yes. And it forces a very stark comparison of the two regulatory environments we discussed today.
How so?
Well, on one side, you have the Australian legislative system introducing new tax frameworks that potentially add severe friction and penalties for non-resident capital.
And on the other side,
On the exact same week, on the other side of the world, you have Dubai actively stripping away friction. They drop the cash requirements for their 10-year golden visa. They approve 34 billion dirham metro lines to drive property values. And they engineer digital pathways for foreign capital to seamlessly enter their market using their local mortgages.
that is a phenomenal strategic contrast. The question for you, the listener, isn't just a micro-level decision of whether an apartment in Business Bay yields 6.5% or 7.6%.
No, it's much bigger than that.
It is a macro-level question about the next decade of your wealth. Which regulatory environment is actively engineering a red carpet to attract and protect your investment, and which environment is quietly erecting toll booths?
That's the real takeaway here.
It brings us right back to the paradox we started with. Transactions being down 31% doesn't mean the market is broken. It means it's shifting gears. The sports car hasn't crashed.
It just slowed down.
Right. It has just slowed down to a speed where you can actually open the door, understand the mechanics of the engine, and safely get in. The speculative frenzy is over, which means the real, calculated investing can finally begin.
Well said.
We're going to leave it there for today. Thank you so much for joining us on this deep dive. I highly encourage you to pull up the source material from Dubai Property for Aussies yourself and model those net yields on the specific communities we discussed. Until next time, keep questioning the headlines and happy analyzing.